Let's look at leverage. Just about anyone can control a property with a relatively small amount of cash, or sometimes no cash at all. That's why real estate investing makes such good late-night infomercials, because any fool can sign on the dotted line and take control. That's called leverage. That's what got me into this business decades ago, and why real estate is still such a sweet way to build wealth. Nowhere else can someone with no cash and no credit get legal control of a valuable asset so easily. Now remember, just because it's possible doesn't mean it's smart. That's where knowing the local market cycle comes in. The most common way to get leverage is by simply getting a mortgage loan. More creative examples of leverage include tying up or controlling a property with an option to purchase, or buying it via installment contract, or buying subject to the existing mortgage. There are dozens of other ways to achieve leverage. That's what all the get-rich-quick programs focus on: how to get control of a property with little or no money down. Here's a simple example. Let's say you bought a $100,000 house by putting $10,000 down. You have what's called a 10-to-1 leverage ratio, meaning for every $10 of value, you invested only $1 of your own cash. Your leverage, 10 to 1. If the value of that $100,000 property increased 7% the first year, you've got a $7,000 gain. 7% times 100,000 is 7,000. Here's where leverage gets interesting. Because you only put up 1/10 of the total value, that 7% gain, that $7,000 first-year appreciation produces a 70% return on your original out-of-pocket investment. You with me? The $7,000 gain divided by your $10,000 investment equals a 70% ROI for the first year. But wait, it gets much better. Or should I say, it can get much better. Let's say the market continues to appreciate 7% a year for the next 6 years. That $100,000 property is now worth $160,578. That's a $60,000 profit on your original $10,000 investment, a 606% return for just one house. See why real estate, leverage, and appreciation can be so profitable? If you're in a rising market, you get wealthier with each passing day. Where else can you get that kind of return? In appreciating markets where a rising tide lifts all boats, you can leverage multiple properties and use more aggressive no-money down strategies. Let's take it a step further and look at an aggressive leveraging strategy, one you'd only use in appreciating markets. This time, instead of putting $10,000 down and buying the property outright, you do a lease option. Let's say you pay the seller a $1,000 option fee on a 3-year deal. The market appreciates 7% a year. After 3 years, the house is now worth over $122,000. There was $22,504 in appreciation. Because your $1,000 upfront investment was so small, the ROI goes through the roof. A 2,250% return on your cash in just 3 years. Now, let's really get aggressive. Let's assume that same $10,000 down payment in the first example, but do 10 lease options at $1,000 a pop. 3 years later, that $10,000 has grown to $225,000, almost $250,000. See how it works? See how you can turn $10,000 into almost $250,000, $225,000? All you need is leverage and an appreciating market. But remember, only a flaming idiot or a green newbie would get this aggressive without first knowing exactly where the local cycle is. Just because you can do deals like this doesn't mean you should. It's the appreciation that made you money, not the lease option strategy. Because when you boil it all down, big-time real estate success is nothing more than a market cycle play. Get the cycle right, you win. Get it wrong, you lose. Compounding appreciation coupled with leverage is how generational wealth is created. It's not any more complex than that. When you've got both leverage and appreciation working for you, it doesn't take long to be set for life. But here's the fine print they don't tell you about. Leverage cuts both ways. Let's go back to that first example where you actually bought a house putting $10,000 down. This time, let's say the property declined 7% the first year. Now it's worth only $93,000. You've lost almost your entire $10,000 in 12 short months. If it declines 7% again the next year, it gets real ugly because now you're underwater. You owe $90,000 on a property worth only $86,000. You've lost your entire investment. Unless you've got spare cash to cover your shortfall and your closing costs, you're totally up the creek without a paddle. You're stuck in out-of-exit options because you couldn't sell it even if you did have a buyer. All you can do now is hope and pray the market bounces back quickly. But it rarely does. That's not how local cycles work. Everyone and their brother are in the same boat, and no one's got a paddle. Some markets take decades to rebound. Houston, Texas is a great example. 30 years after its big crash, and real home values are still way below their peak. They've not even kept up with inflation. The only good solution is to avoid getting into that mess in the first place, because real estate is just too illiquid. Once market psychology takes over, everyone starts running for the exit doors, and you can't get out even if you wanted to. The bottom line is this: leverage multiplies the effects of appreciation or decline. It does not by itself create any wealth. Let me say that again. Leverage does not create wealth. If the property value declines, leverage multiplies that pain the same way it multiplies wealth on the upside. Most real estate education products out there teach you a particular spin on how to get properties with little or no money. Leverage. That's just a small part of the equation, and it's not the important part. What you should be focusing on is the second part of that equation, the part that actually creates the wealth, appreciation. The key to leverage is making sure your use of it matches where your local market is in its cycle. Otherwise, leverage is just another form of Russian roulette. It's irresponsible to use leverage, or for that matter, even doing a deal, unless you know where you're at in your local cycle. Appreciation, not leverage, is what makes you money. It's a simple concept, but as a real estate investor, nothing's more important to you. If you get nothing else from this webinar, then please lock this into your permanent memory. Appreciation, not leverage, is what makes you money. Okay, there are two types of appreciation: forced and automatic. Forced appreciation is what we as traditional real estate investors were taught to focus on. Buy low and hopefully sell higher. Forced appreciation investors only make money on the spread, the difference between what you've got in it and what you get out of it, after all expenses are paid. With forced appreciation, your upside profit is limited. It's transactional income, not wealth. Automatic appreciation, on the other hand, is unlimited. It applies to any man, woman, or child who owns or controls real estate. It's really important you understand the difference. Forced appreciation is where you build an acquisitions funnel to find motivated or uninformed sellers. You cast a wide net, filter potential deals, and try to buy properties below market. Once you have them tied up or purchased, you try to add value to things like rehabbing or marketing. You force the appreciation and profits through your hard work and special skills. It's what most real estate investing books and guru home study courses have been teaching for the last 30 years. Tactics like pre-foreclosures, wholesaling, sub-twos, probate, tax deeds, rehabbing, etc., etc. There's nothing wrong or hard about buying properties below market. It just takes time and money. It's a job. You stop doing it, your income stops. It's transactional income, not wealth building. I'm going to go a step further and say generally, those forced appreciation strategies aren't even profitable unless your tactics are in sync with your local market cycle. Remember that big, successful Tampa, Florida wholesaler who lost just about everything when the market tanked? He did great when the market was appreciating, but got clobbered when the market went downhill. Remember those other forced appreciation strategies we mentioned in the beginning? Subject twos, pre-construction, and lease options? They only work in appreciating markets too, and they can drive you to bankruptcy in falling markets. You see where I'm going? If all these transactional income strategies only work in rising markets and do poorly in falling markets, then what's really the main driver of your success or failure? It's the market, isn't it? Forced appreciation strategies can't be done in a vacuum. They still need a vibrant market to succeed. You've got to know the local market cycles even if all you're after is transactional income. Thinking that forced appreciation strategies are the source of your success is no different than that bantam rooster thinking his crowing is what makes the sun come up. Automatic appreciation is different. It occurs when the value of your property goes up naturally or automatically, just because of where and when you own or control it, not from anything you did. Unlike forced appreciation, where you're limited to the spread between your purchase and sale price, automatic appreciation has massive, unlimited upside potential. Remember that $15 trillion worth of wealth creation in the last upcycle? Well, 99.9999% of that was automatic appreciation. Think of that $15 trillion in new wealth in terms of all the surface sand on Miami Beach. Now go pick up one single grain of that sand. You're looking at forced appreciation's contribution to that $15 trillion of wealth. All the money made from forced appreciation strategies would be like a single grain of sand. It's insignificant and barely worth discussing, yet it gets all the attention. Ever since the advent of late-night infomercials, investors have been taught to focus on the wrong thing. Forced appreciation. It's not where the money is. I was too for the first 10 or 15 years of my career because that's all there was. So we all focused on that tiny grain of sand we could have control over, our tactics. Until I came along and invented the only system that works at the local level, buying for appreciation was considered speculation. Well, it's not speculation anymore. There's real proven science behind it. and an uncontested track record I'll show you in a minute. But that's not even the best part about automatic appreciation. This is. Automatic appreciation requires no special real estate skills. It has unlimited acquisition candidates. You don't have to deal with motivated, desperate, or uneducated sellers unless you want to. Every property qualifies. It's lower risk and it's easy. You only have to do one thing right: know the local cycle. It can be combined with any forced appreciation or transactional income strategies you want to use to exponentially explode your results. But if you don't have time or interest for all that specialized stuff, you can still capture the lion's share of the wealth while avoiding most of the risk and effort. I call it the far gap ham system.